The building is silent now. Its granite facade stands witness to nothing, to no one, just the steady pulse of money moving through fiber optic cables buried beneath Wall Street's ancient cobblestones. Inside, traders stare at screens that flash green and red, oblivious to the blood that once stained the ledgers of their predecessors. It's 1945, and somewhere in a vault 3 stories below street level, a banker is burning documents. Not all of them, just enough. Just the ones that show exactly how much he profited from the regime that turned Europe into an abattoir. The smoke rises through the ventilation shaft, and with it, a secret so monstrous that even now, 8 decades later, we can barely acknowledge it. The banks that gambled recklessly in the 20s that collapsed under the weight of their own greed and dragged the world into the Great Depression, that then turned around and financed the Nazi war machine. These same institutions would emerge from World War II not punished, not dismantled, but saved. Stronger than ever, richer than ever, because the war they helped make possible became the very mechanism of their redemption. When does ambition become complicity? When does the pursuit of profit cross into the territory of moral catastrophe? This is the question that haunts every page of this story, every transaction, every carefully worded memo that danced around the truth. Because what happened between 1929 and 1945 wasn't an accident. It wasn't a series of unfortunate coincidences. It was a pattern of institutions so drunk on their own power, so convinced of their invincibility that they couldn't see, or perhaps didn't care, that they were building the scaffold for their own hanging. And then, in the most perverse twist of all, they discovered they could use the scaffold as a ladder. The Roaring Twenties. Even the name drips with excess, with champagne and jazz, and the intoxicating belief that the party would never end. On the surface, America was a miracle of modernity. Automobiles rolling off assembly lines, radios in every home, skyscrapers clawing toward heaven. But beneath the glitter, beneath the ticker tape parades and the speculative fever, the financial system was a house of cards built on sand. Banks had become casinos, and the American people were the chips. It started innocently enough, or so the bankers told themselves. New industries, automobiles, refrigerators, radios, required capital, and banks were eager to lend. But lending turned to enabling, and enabling turned to addiction. Farmers who could barely afford seed borrowed to buy stocks. Shopkeepers mortgaged their stores to chase the market's dizzying ascent. And the banks? They funded it all, loaning money to speculators who bought on margin, putting down as little as 10% of a stock's price and borrowing the rest. The banks themselves were in on the game, buying stocks with depositors' money, convinced that the market could only go up. They weren't just fueling speculation. They were speculation. The numbers tell part of the story. Between 1921 and 1929, the Dow Jones surged from 63 points to 381, a rise so steep, so divorced from economic reality, that even the bankers started to grow nervous. But they kept lending, kept pushing, kept whispering to their clients that this was the new normal, that the old rules no longer applied. After all, wasn't this America? The land of limitless possibility? Why worry about fundamentals when optimism could be packaged and sold like any other commodity? But fundamentals have a way of demanding attention. Farm incomes were collapsing throughout the 20s, crushed by overproduction and debt. Workers' wages remained stagnant even as corporate profits soared. More than 60% of Americans lived below the poverty line, while the wealthiest 5% controlled a third of all income. The richest 1% owned 40% of the nation's wealth. This wasn't prosperity. It was a Ponzi scheme dressed in a tuxedo, and the Federal Reserve, America's central bank, the institution supposedly tasked with maintaining financial stability, was too timid, too slow, too captured by the very banks it was meant to regulate to do anything about it. When the Fed finally raised interest rates in 1929, trying to cool the speculative fever, it was like throwing a bucket of water on a forest fire. By then, the flames were already out of control. October 1929. Black Thursday. Black Tuesday. The names feel quaint now, sanitized by history into mere calendar dates. But in those October days, panic swept through Wall Street like a contagion. Stocks that had been worth fortunes became worthless paper. Brokers called in their margin loans, demanding cash that borrowers didn't have. Banks that had lent recklessly now faced their own reckoning as depositors, terrified of losing everything, lined up by the thousands to withdraw their savings. And the banks? They couldn't pay. Between 1930 and 1933, roughly 9,000 banks, more than a third of all American financial institutions, collapsed. The lifetime savings of millions of Americans vanished overnight. The money supply contracted by 30%. Credit evaporated. Businesses shuttered. Unemployment skyrocketed to 25%. By 1933, a dozen eggs cost 13 cents, down from 50 cents in 1929. Deflation, that rare and terrible beast, was devouring the economy. The conventional narrative places banks among the victims of this catastrophe. Poor, innocent banks caught in the crossfire of forces beyond their control. But Ben Bernanke, himself an economic historian and former Federal Reserve Chairman, knew better. In a 2002 speech that should have shocked the nation but barely made a ripple, Bernanke addressed the role of the Fed and the banks in the Depression. His words were stark, almost confessional. Regarding the Great Depression, he said, "We did it. We're very sorry." The apology was directed at Milton Friedman, whose work had long argued that the Fed's failure to act as a lender of last resort turned a recession into a cataclysm. But Bernanke's admission went deeper. The banks weren't passive victims. They were architects. They had fueled the speculation, ignored the warning signs, gambled with depositors' money. And when it all came crashing down, they had let the system burn rather than take the losses themselves. They failed to manage their reserves properly, failed to support each other during the panic, failed in every duty a financial institution owes to the society it serves. And yet, somehow, this same system would be rescued, rebuilt, and within a decade, will be financing the greatest war in human history. Because across the Atlantic, in the ruins of Weimar Germany, another kind of catastrophe was unfolding, one that would prove equally profitable for those who knew how to read the room. Germany in 1933 was a nation in agony. The Great Depression had hit it harder than almost anywhere else. Unemployment approached 30%. The currency had collapsed in the hyperinflation of 1923, wiping out the savings of the middle class. The Treaty of Versailles had saddled the country with impossible reparations, and the shame of defeat in World War I festered like an open wound. Into this void stepped Adolf Hitler, a man whose pathological hatreds would soon metastasize into the worst crime in human history. But Hitler didn't seize power alone. He had help, lots of it, and much of that help came from banks, German banks, European banks, and yes, American banks. The story of how the Nazis financed their rise and their rearmament is a masterclass in financial sorcery. At the center of it stood Hjalmar Schacht, a brilliant, amoral economist who served as president of the Reichsbank and Hitler's Minister of Economics. Schacht understood something fundamental. Money is belief. If you can convince people, or banks, that a piece of paper has value, then it does, at least until reality comes knocking. And Schacht knew how to keep reality at bay. His greatest innovation was the creation of the MEFO bill, a promissory note issued not by the government directly, but by a dummy company called Metallurgische Forschungsgesellschaft, or MEFO. On paper, MEFO was a private metallurgical research firm capitalized by Germany's four largest armament manufacturers, Krupp, Siemens, Gyut Hoffnungschutt, and Rheinmetall. In reality, it was a shell, a legal fiction designed to hide Germany's rearmament from the world and from Germany's own budget. Here's how it worked. The Nazi government would contract with an arms manufacturer, say Krupp, to build tanks or artillery. Instead of paying in Reichsmarks, which would show up in the federal budget and alarm the international community, the government paid in MEFO bills. These bills carried a generous 4% interest rate and were guaranteed by the German government. They could be redeemed at the Reichsbank after 5 years, but in the meantime, they could be traded between companies like cash. Banks loved them because they could hide them on their balance sheets, concealing the true extent of Germany's debt from shareholders and regulators. Between 1934 and 1938, the Nazi regime issued 12 billion Reichsmarks worth of Mefo bills, more than the entire national debt of Germany before Hitler took power. To put that in perspective, Germany's national debt in 1932 was 10 billion Reichsmarks. By 1938, the admitted debt was 19 billion, but that figure didn't include the Mefo bills. In just 6 years, Hitler and Schacht had tripled Germany's national debt, with more than half of it hidden off the books. At the Nuremberg trials after the war, Russian Judge Iona Nikitchenko called the Mefo system a swindling venture on a national scale that has no precedent. But here's the thing, it worked. It worked because banks were willing partners. German banks bought the Mefo bills, accepted them as collateral, traded them among themselves, all while knowing exactly what they were financing. Deutsche Bank, Dresdner Bank, Commerzbank. These institutions didn't just passively accept Mefo bills. They actively facilitated the scheme, helping the Nazis circumvent international scrutiny and domestic financial laws. Deutsche Bank even financed the construction of IG Farben's facilities in Auschwitz concentration camp, using gold stolen from Jewish victims. After the war, Deutsche Bank chairman would offer a grim apology, acknowledging the bank's ethical and moral responsibility. But the money had already been made. The tanks had already rolled. The camps had already done their work. And across the Atlantic, American banks were watching, and more than watching. They were participating. This is where the story becomes almost unbearable in its audacity. Even as Germany rearmed in flagrant violation of the Treaty of Versailles, even as the Nazi regime made its intentions brutally clear, American financial institutions maintained and even expanded their relationships with Germany. Wall Street had been deeply invested in Germany's economic recovery after World War I. J.P. Morgan's Thomas Lamont had led the renegotiation of reparations payments and organized a consortium of banks to bail out Germany in the 1920s. When the Depression hit, these investments looked precarious. But the Nazi regime, with its massive rearmament program, offered something Wall Street craved: stability through state intervention and guaranteed returns. Consider Chase National Bank, predecessor to today's J.P. Morgan Chase. Between 1936 and 1941, Chase facilitated a scheme that would have been comic in its brazenness if it weren't so sinister. The Nazis created a special kind of currency called Rückwanderer Marks, Returning Marks, supposedly for Germans living abroad who planned to return to the fatherland. Chase sold these marks to Americans of German descent at a discount. Here's the sick genius of it. The marks were valued below face value because they came from accounts seized from Jews fleeing Nazi Germany. In other words, Chase was helping the Nazis liquidate stolen Jewish assets, converting them into dollars that could be used to buy American goods for the German war machine. Between 1936 and 1941, the Nazis amassed more than $20 million through this scheme. The banks facilitating these transactions earned $1.2 million in commissions. Chase's cut? Over $500,000. $500,000 earned by selling the seized assets of Holocaust refugees back to Nazi Germany. And Chase knew. Documents declassified by the FBI in 2004 make this crystal clear. As one memo noted, the financial houses understood that the German government paid the commissions through the sale of discounted, blocked marks that came mainly from Jews who had fled Germany. When France fell to the Nazis in 1940, most American businesses evacuated. Not Chase, not J.P. Morgan. They kept their Paris branches open, doing business with and for the Nazi occupiers. They froze the accounts of Jewish customers. They provided financial services to the Gestapo. Carlos Niederman, Chase's branch chief in Paris, wrote to his supervisor in Manhattan in May 1942, 5 months after Pearl Harbor, 5 months after America had entered the war, that the bank enjoyed very special esteem with top German officials and was seeing a rapid expansion of deposits. Think about that date. May 1942. By then, the Einsatzgruppen had already murdered hundreds of thousands of Jews in Eastern Europe. The gas chambers at Auschwitz had been operational for months. American soldiers were dying in the Pacific and preparing for the invasion of North Africa. And Chase's man in Paris was bragging about his excellent relationship with the Nazi occupiers. The FBI opened an investigation in 1941. A grand jury was convened. Federal prosecutors had Chase dead to rights for violations of the Johnson-Debt Act, the Espionage Act, and the Foreign Agents Act. But the bank's lead attorney, a former U.S. attorney who knew all the right pressure points, threatened to expose FBI, Army, and Navy sources and methods in open court. The government blinked. No charges were ever filed. No executive ever saw the inside of a prison cell. The money was never repaid. If stories like this fascinate you, if you believe these hidden chapters of history deserve to be told, consider leaving a like. It helps bring more of these uncomfortable truths to light. But Chase wasn't alone. The Bank for International Settlements, established in Basel, Switzerland in 1930, ostensibly to facilitate German reparations payments, became something far more sinister during the war, a clearinghouse that allowed Allied and Axis banks to continue doing business with each other even as their nation's soldiers slaughtered each other on the battlefield. The BS board included representatives from the Reichsbank, the Bank of England, and 3 Morgan-affiliated banks. When Germany annexed Austria in 1938, the BS helped facilitate the transfer of Austria's gold reserves to the Reichsbank. When Czechoslovakia fell in 1939, the BIS assisted in the theft of Czech gold, a heist orchestrated by Germany with the cooperation of the Bank of England. £5.6 million in gold, transferred from Czech accounts to German accounts while Britain's central bank looked the other way. And presiding over all this, during the entire war, was an American, Thomas McKittrick, a Wall Streeter who moved freely through Nazi territory in fascist Italy, whose ship was given safe passage by German U-boats so he could conduct BIS business. When the war ended, McKittrick didn't face prosecution. He was made vice president at Chase National Bank. Let that sink in. The man who ran the bank that laundered Nazi gold, that facilitated exchanges between Hitler's regime and supposedly neutral Sweden, that helped Germany access foreign currency throughout the war. This man was rewarded with a plush job at one of America's most powerful banks. Because by 1945, the script had flipped. The war that these banks had helped finance was now saving them. Here's the perverse mathematics of it. When America entered World War II, the government needed to finance the most expensive military operation in human history. The federal deficit exploded. Between 1941 and 1945, federal spending increased from roughly $15 billion to $98 billion, a staggering rise that would have been unthinkable in peacetime. To pay for it all, the government sold war bonds, trillions of dollars worth of bonds. And who bought these bonds? The American people, certainly. 85 million Americans purchased over $185 billion in war bonds, often through automatic payroll deductions. But the real money, the real volume, came from the banks. Commercial banks purchased 31% of all marketable debt issued between 1940 and 1945. The Federal Reserve bought another 13%. By the end of the war, banks held more than 50% of all marketable treasury debt. Government obligations accounted for 57% of total bank assets. Think about what that means. The same banks that had collapsed by the thousands during the Depression, that had gambled with depositors' money and lost, that had financed Nazi Germany's rearmament. These banks were now the primary creditors of the United States government. And this time, they couldn't lose. The government guaranteed the debt. The Federal Reserve pegged interest rates at artificially low levels to keep borrowing costs manageable. Treasury bills at 0.3%, far below the peacetime rate of 2 to 4%. This wasn't charity. It was symbiosis. The government needed the banks to finance the war. The banks needed the government to restore their balance sheets and their reputations. And both got what they wanted. Bank balance sheets, which had been decimated during the Depression, doubled between 1941 and 1945. The ratio of equity to assets, a key measure of financial health, plummeted as banks gorged on low-risk government debt. When the Federal Reserve tried to enforce capital requirements in the early 40s, the the requirements quickly became unbearable given the pace of bank expansion. So the Fed revised them, creating a new equity-to-risk asset ratio that excluded cash and treasuries. In other words, the government debt that banks were buying to finance the war didn't count against capital requirements. Banks could expand almost limitlessly, buying war bonds with depositor money and borrowed funds, without having to hold additional capital as a cushion. It was the kind of regulatory leniency that would have been unthinkable a decade earlier. But these weren't ordinary times. The war effort demanded coordination on a scale that peacetime capitalism couldn't achieve. And so the banks, chastened by depression and scandal, rehabilitated by war, emerged from 1945 in a position stronger than they had occupied at any point in history. The irony is almost too perfect. The very conflict that these institutions had helped create, through their reckless speculation in the 20s, their financing of Nazi rearmament in the 30s, their willingness to look the other way as Hitler prepared for conquest, became the mechanism of their salvation. Because war, it turns out, is clarifying. It turns moral ambiguity into necessity. It transforms collaboration into patriotism, as long as you're collaborating with the right side by the time the shooting starts. And after 1941, American banks were emphatically on the right side. They sold war bonds. They financed defense contractors. They supported the troops. Suddenly, the same institutions that had profited from Mefo bills and Rwanda remarks were wrapping themselves in the flag, marketing their government bonds with imagery of soldiers storming beaches and workers building tanks. The Federal Reserve banks established victory fund committees. Volunteers were recruited. Bond drives were organized with the kind of fervor normally reserved for religious revivals. The Chicago Federal Reserve processed 271 million checks in 1941. By 1956, that number had swelled to over 500 million, requiring the bank to operate 24 hours a day. 40% of its employees were engaged in clearing checks. This was the machinery of war, the circulatory system through which money flowed to feed the arsenal of democracy. And the banks were the heart of it. But the transformation ran deeper than balance sheets. The war also gave banks a gift more valuable than profit: legitimacy. The Banking Act of 1933, which had created the Federal Deposit Insurance Corporation in the wake of the Depression's bank failures, had stabilized the system but hadn't restored public trust. People remembered the lines outside failed banks, the lost savings, the betrayal. But the war changed the narrative. By funding the war effort, banks became partners in victory. They weren't the villains of the Depression anymore. They were the financiers of freedom. This rhetorical alchemy was abetted by the New Deal's regulatory structure. Glass-Steagall separated commercial and investment banking. Capital requirements were tightened. Bank examiners scrutinized balance sheets with newfound rigor. The Wild West of the 20s was over. Banks operated within a framework of rules designed to prevent another catastrophe. And for a time, a brief, shining time, it worked. In 1947, bank lending surged from 16% of assets to 25% as the economy transitioned to peacetime production. By the late 50s, lending reached 40% of assets. Banks were doing what banks were supposed to do, providing credit to fuel economic growth. Failures, which had numbered in the thousands during the Depression, became almost non-existent. The cautious attitudes of bankers and regulators, combined with the post-war economic boom and the stability of the Bretton Woods monetary system, made banking boring again. Profitable, but boring. And boring is good when the alternative is catastrophe. But beneath the surface, the seeds of future crises were already being sown. Because the fundamental lesson the banks learned from the Depression and the war wasn't don't gamble recklessly. It was make sure you're big enough, important enough, systemically critical enough that when the reckoning comes, the government has no choice but to save you. This is the origin of too big to fail, though that phrase wouldn't enter the lexicon for another half-century. The banks that emerged from World War II had proven that they were indispensable. Without them, the government couldn't finance its operations. Without them, the economy couldn't function. They had become infrastructure, as essential as roads or power grids. And once your infrastructure, the rules change. You're not just a private business anymore. You're a public utility with private profits. It's a hell of a deal, and the banks weren't about to let it go. The post-war years saw the consolidation of banking power on a scale that would have horrified the Founding Fathers. The big New York banks, Chase, Morgan, National City, grew bigger. Regional banks were absorbed. The Northeastern Republican establishment, with its close ties to Wall Street, dominated economic policy. When Eisenhower defeated Taft in 1952, opposition to this financial elite was marginalized within the Republican Party. The Democrats, shaped by the New Deal, accepted the regulatory framework but didn't challenge the underlying structure of power. Both parties agreed. The banks were partners, not adversaries. This consensus held through the 50s and 60s, a period of relative stability. But it rested on a foundation of historical amnesia. The Depression was receding into memory. The war, despite its horrors, had become a story of heroism and triumph. The uncomfortable questions about who financed Hitler, about how banks profited from stolen Jewish assets, about the cozy relationships between Wall Street and the Reichsbank. These questions were quietly buried, along with the documents that Thomas McKittrick and his colleagues had burned in 1945. It's worth pausing here to consider what didn't happen. There were no Nuremberg trials for American bankers. Hjalmar Schacht, the architect of Nazi economic policy, was tried at Nuremberg and acquitted, thanks in part to his defense that the 1939 memorandum criticizing the unsustainability of Nazi fiscal policy was an act of resistance. It was a fiction, of course. Schacht wasn't resisting Nazism. He was worried about inflation. But the judges bought it, or chose to buy it, because the alternative was too uncomfortable. If Schacht was guilty, then so were the Allied bankers who had worked with him, who had facilitated his schemes, who had profited from them. Deutsche Bank's executives, who had financed Auschwitz, faced some scrutiny after the war. The bank eventually acknowledged its ethical and moral responsibility. But no one went to prison. The bank continued to operate, and today it's one of the largest financial institutions in the world. Chase National Bank, which earned $500,000 selling Jewish assets to the Nazis, paid a modest settlement in 2000, 55 years after the war, for under $1 million. The settlement made Chase Manhattan the first bank to reach an agreement over Holocaust-related claims, a distinction that sounds noble until you realize it came only after FBI documents were declassified and the bank's hand was forced. The actual architects of these schemes, the executives who signed off on the transactions, the traders who processed them, the lawyers who structured them, faced no consequences. They retired wealthy. They were lauded as pillars of their communities. Some have buildings named after them. This is not ancient history. The structures built during this period, the consolidated banking system, the too-big-to-fail doctrine, the revolving door between Wall Street and Washington. These are the foundations of our current financial order. When the Bretton Woods system collapsed in 1971 and the world shifted to floating exchange rates, the banks adapted. When Glass-Steagall was repealed in 1999, allowing commercial and investment banks to merge again, the banks that benefited were the direct descendants of the institutions that had financed the Depression and the war. J.P. Morgan Chase, formed from the merger of Chase Manhattan and J.P. Morgan, carries the legacy of both institutions that did business with Nazi Germany. Deutsche Bank still operates globally. The Bank for International Settlements still sits in Basel, still facilitates transactions between central banks, still operates with the kind of opacity that would make Thomas McKittrick proud. And when the financial crisis of 2008 hit, when banks once again gambled recklessly with other people's money and brought the global economy to the brink of collapse, what happened? The government bailed them out. $700 billion in TARP funds, trillions more in Federal Reserve support. Because they were too big to fail. Because without them, the economy would collapse. Because they had learned the lesson of 1945. If you make yourself indispensable to the state will save you, no matter what you've done. It's the same pattern, repeated across generations. Speculation, collapse, scandal, bailout, rehabilitation, consolidation. And then it starts again. The specific mechanisms change, Mefo bills give way to mortgage-backed securities. Ruckwander marks give way to credit default swaps. But the structure remains the same. Banks take risks they shouldn't take, make profits they shouldn't make, and when it all goes wrong, the public absorbs the losses while the banks absorb the lessons and how to do it better next time. The men who burned those documents in 1945 understood something fundamental about power. It's not what you did that matters. It's what can be proven. It's not about justice. It's about control of the narrative. And for 75 years, the narrative has been carefully managed. The Depression was about speculation, not banker malfeasance. The war was about defeating fascism, not about the uncomfortable alliances that made fascism possible. The post-war boom was about American ingenuity and the Marshall Plan, not about the rehabilitation of institutions that should have been dismantled. But the documents don't burn forever. Archives open. Journalists dig. Historians piece together the truth from fragments and footnotes. And slowly, the shape of the thing becomes visible. Not a conspiracy. Exactly. Conspiracies require coordination, secrecy, a unified plan. This was something more banal and more insidious. A system that rewards amorality, that elevates profit above principle, that allows institutions to fail upward as long as they're powerful enough. It's a system that took root in the 1920s, survived the Depression, metastasized during the war, and continues to thrive today. So here we are, 8 decades later, standing in front of that same building on Wall Street. The traders are still there, still staring at screens. The money is still moving, faster now, through algorithms and high-frequency trading systems that execute millions of transactions per second. But the fundamental dynamic hasn't changed. The banks are still too big to fail. The government is still dependent on them. The public is still funding the system through their deposits and their taxes. And the uncomfortable questions about who profits from catastrophe, about how institutions that facilitate horror are rewarded rather than punished, about the price we pay for forgetting history. These questions remain unanswered, because answering them would require confronting a truth more disturbing than the crimes themselves, that the system worked exactly as designed. The Depression didn't happen in spite of the banks. It happened because of them. The war didn't happen in spite of the financial system. It was enabled by it. And the recovery that followed didn't happen in spite of these institutions' complicity. It happened through their rehabilitation, their transformation from villains to heroes, from collaborators to patriots. It's a magic trick when you think about it. The greatest illusion in modern economic history. And we're still living inside it, still believing that the institutions that caused the catastrophe are the only ones capable of preventing the next one. Still accepting that the price of stability is amnesia, that the cost of order is complicity with those who profit from disorder. The smoke from those burning documents rose through the ventilation shaft in 1945 and dissipated into the New York sky. But the secrets didn't disappear. They transformed, mutated, became the foundational myths of the post-war order. And now, when we look at our financial system, when we marvel at its resilience and its power, when we wonder how it survived the Depression and the war and every crisis since, we should remember, it survived because the war saved it, not in spite of the bank's behavior, but because of it, because they made themselves indispensable, because they learned that there is no crime so great, no complicity so damning, that it can't be erased by the simple expedient of being too important to punish. What would you have done if you were in their place? If you had been the banker in 1935, offered a lucrative contract to facilitate German currency transactions? If you had been the executive in 1942, deciding whether to keep your Paris branch open under Nazi occupation? If you had been the regulator in 1946, with the power to prosecute or to look the other way? The question isn't rhetorical. It's the only question that matters. Because the system that allowed those choices, that rewarded them, that protected the people who made them, that system is still here. The banks are still here. The incentives are still here. And the next catastrophe, whatever form it takes, is coming. Tell me in the comments. Where do you draw the line between survival and collaboration, between pragmatism and complicity? And if you crave more stories that test the limits of truth and power, that pull back the curtain on the hidden mechanisms that shape our world, subscribe. Because the next one might just change how you see history itself. Not as a series of discrete events, but as a continuous thread of choices and consequences, of crimes and amnesias, of institutions that learn to fail upward and societies that forget why they should have learned better.